So many of you are asking me about SOFI stock, mainly because it's down over 12% on earnings, even though they actually beat earnings and their metrics were not bad at all. So I decided to finally do a video on SOFI. Now, before I start the video, I have to say I might have some type of a negative bias around SOFI, mainly because I was short the stock many times in 2022, not just SOFI. I was short after many of those type of stocks. I was very bearish on the economy. I saw, they had, a lot of problems and a lot of people could potentially default, which I was wrong, but they did, miss on earnings anyway, and they were too overpriced. But I was mainly short SOFI whenever they made a mistake and they accidentally dropped the earnings release much earlier than the close. And then the stock went down like 22%. My puts were up over 200%. And what happened? They halted the stock for like an hour or 45 minutes. Then whenever, SOFI came back, it was down 22%. Now it was only down 8 or 9%. And I got IV crushed. So my puts that were up 200%, I only got like 45%, on the upside from those puts. So I might have a negative bias with SOFI, but I think I have a lot to say on the company in terms of the positive stuff, in terms of the negative stuff. I'm going to talk about both case scenarios and give you my valuation model so we can determine a fair price for SOFI. So SOFI's earnings were actually pretty amazing. I mean, they did beat on revenue, around 5% beat. They beat on adjusted EPS, which I'm not a big fan of, around 49% beat, which is not bad at all. Most of the beat was largely due to the massive personal loan origination volumes. They shot up over 46% as people need money. I mean, we don't have stimulus checks anymore. We don't have all those things, and personal loan origination volumes are shooting up like crazy, and SOFI is making a killing from it. Now, I'm not going to try to introduce SOFI to you because most of you are familiar with them. They give you personal loans, they give you student loans payments, they give you credit cards, they give you all kind of other things, like broker account. Most of you are really, familiar with it, and it went via a SPAC by someone that wasn't the best person in the SPACs. I mean, he dumped them Kamas. He pretty much dumped all these SPACs like Virgin Galactic and, SOFI and all these stocks, and people were left, holding the bag. But this is how SOFI actually came, on the market. But they actually been adding many members. They added, massive amount of members. Even, in Q1 of 2023, they added around 433,000 new members, a 43% year-on-year growth. Again, this is massive, a membership growth. They are taking market share from these other companies, from legacy banks and many others. So all of it is actually pretty amazing. Now, here comes the income statement, which is, one of the three bad things I'm going to talk about with SOFI. I'm going to talk about three bad things, then I'm going to talk about an amazing catalyst, and then finally, I'm going to give you my valuation model on SOFI. Now, SOFI is still posting a net loss in 2023. And yes, you might be able to use an adjusted EPS, an adjusted EBITDA, and all these adjusted type of metrics and try to justify that SOFI is somewhat profitable. But actually, their net loss got much better than expected. When I was shorting the stock, they were losing like 150 or 200. Now they're only losing 34. So it actually got much better. And the main reason for the massive loss is actually mainly, a lot of spent on sales and marketing. And this is the only way SOFI can actually gain all those customers is if they spend up more on, advertisement and sales. This is how they can keep taking market share from their competitor. Now, the beauty about SOFI is once they actually get a member to any of their products, like a personal loan, they can cross-sell all of the products. Maybe you need a car loan. Maybe you need a broker account. Maybe you need a high-yield saving account. So they can cross-sell a lot of those things whenever they just get someone sucked into the SOFI program in any of their programs. So it's a pretty amazing business model, but they have to keep increasing the sales and marketing or the competition is going to eat them alive. And this is just the way with these, type of companies. It's a highly competitive space and they have to keep spending up on sales and marketing. But if they were spending less on sales and marketing, they could have been profitable actually in first quarter of 2023, but they actually didn't do so, and they can't do it if they slow down ad spending. Then competition is going to take more market share, and then maybe SoFi is going to be dead a few years from now. So this is something they have to keep spending on. But, looking at the net loss, it has improved. It's getting much, much better. And I'm very happy from the work that the management is doing as SoFi. Now, the second, bad thing with SoFi, this is something very, very important. It's one of the reasons why I was short SoFi in 2022 many, many times. And it was the reason why I was short Affirm also in 2022, is because these companies are desperate to actually, do whatever it takes to grow members, to grow those numbers, to keep up with the expensive valuations that SoFi had, in 2022. Now this valuation is getting better. It's much, much cheaper than it was before, but they are trying to do whatever it takes. They are desperate to get new members, and you could clearly see it in the trend. For example, looking at the 599 or below credit scores, it's around pretty close to 32 right now. It was 0 in 2021. You could look between 600 to 619. Now it's pretty close to 9. Before it used to be 0 in 2021. I mean, you could look at the trend from 620 to 639, which is also a bad credit score. It's pretty close to 15.5, and it used to be around 700 in 2021. And you could see how SoFi is pretty much same with Affirm. They are desperate to get new members, even if they have to go to the lower tier members, not just in credit card, but in a few other of their programs. Here I'm just looking at the credit card data, which might not seem like a lot, but you could look from their intentions if they are willing to do whatever it takes just for the sake of keeping up the massive member growth, keeping up all those things for the sake of the short-term type of performance. These things could actually come back to bite them in the long term. If we do have, for example, a recession, or God forbid something like COVID happens a year or two from now, and maybe this time we don't have those stimulus checks and the massive unemployment checks and all these type of things that we had before, then what's going to happen to those 599 credit scores, which most of them actually have a bad history of being late in good times? Then what are they going to do in bad times? Now, I have to be fair that the credit scores of the FICO of above 800 actually also grew in 2022. So they are also attracting higher tier, higher FICO scores type of members, which is very, very important. But all I'm trying to highlight in this video is the intentions of the management team at SoFi and Affirm and all these companies to go the extra mile of doing whatever it takes just for the short-term metrics of growing members and all these kind of things, which is great, but you have to pay attention to those things that maybe they will eventually come back, to bite SoFi, and in this case, as a shareholder, you could potentially suffer a lot. The last bad thing, which is not as bad as it used to be before, is actually the shares outstanding. This is something you have to pay attention to with these growth companies. A lot of them are actually diluting shareholder. Now, SoFi have been doing it since, mid 2021, but in 2022 to early 2023, it's actually been getting better, from the CEO. He's doing a lot of good things, which I like, and it's been getting better. It's not as much as it used to be, in 2021, but this is something you have to pay attention to as a shareholder. Now, something that's amazing for SoFi, and this is actually a short-term catalyst that could be pretty beneficial to SoFi, is actually the student loans. If you didn't know, SoFi actually has a student loan portfolio. And what did we have in the United States? We still have a pretty much, a ban or a suspended payment. So you don't pay any payments on a student loan. It's pretty much paused. It's been paused, I believe, since the pandemic. So SoFi has not been making a lot of money on those student loans, and they made around 525 million in 2023. They used to make pretty close to $1 billion in 2022. Now look at this screenshot that I posted in my own investment group. In 2021, they made pretty close to $1.5 billion from student loans. From $1.5 billion, they went to 400 million, just because those student loans were actually paused. The interest was not like it used to be. The origination is not as good as it used to be. So this is something, that's hurting SoFi right now. And if it changes, where we could potentially have a decision from the Supreme Court, there's a lot of different articles, but this one, it says late June. So if they make a decision in late June to actually resume those student loan payments, SoFi is going to benefit a lot from it. They might get back to $1 billion type of, student loan originations and interest rate collections. So this is going to benefit SoFi a lot. And I don't personally believe it's actually priced in the price. I believe the worst scenario is pretty close to being priced with SoFi. It was trading around, $24, $5 per share. Now it's around $5.50 per share. So I don't believe the student loan catalyst is priced in within SOFI. If it happens over the next few months, this could cause a massive upside move on SOFI. But if it doesn't happen, I'm not sure how the stock will react. Looking at this chart, I believe a lot of the worst is actually priced in, within the company. Now, this was the trickiest part about SOFI, is actually coming up with a valuation, because it's pretty hard to actually value, growth companies that are actually not profitable or not very profitable. Which net income margin do you assign? What is the gross number you assign, and all these type of things. So sometimes I try to rely on the analyst estimates. This is from over 15 analysts. They came up with these gross numbers, and this is what they have. They have SOFI actually losing money until 2024 and starting to be net income normalized profitable, which is, adjusted EPS in around 2024, 5 to going into 2026. So they expected to lose money until 2024, and they expect the gross numbers between 27%, 23%, so between, 18 to 24%. So I used a fair 20% estimate from 2023 to 2027, which I believe is very, very fair. Now, for the net income margin, this is where I struggled. SOFI is not profitable, so I looked at other companies like Lending Tree, Lending Club. They have net income margins around 3, 4, 5%, type of net income margins. So I used a 6% net income margin for SOFI. It's more than fair, but I'm trying to be fair with the valuation. A PE ratio, which is on the high side. I'm going to tell you why, and I'm going to give you the other case scenario. I put in a 40 PE ratio, which is actually double the growth. Now, I believe many, value investors, they try to value growth stocks, and they see a company growing 20%, and they say, oh, this company should be trading at 14 times earnings or 10 times earnings or 18 times. This is not the way to do it when you're valuing a growth company. What I try to do, I try to put in the PE ratio double the growth, and I'm going to use a lower estimate in the future. But if I use all these metrics, the 6% net income margin, the 40 PE ratio, which is more than fair for the company, I get around 80% on the upside, or 12% compounded every single year for the next 5 years. Now, there's a lot of things that could go wrong with this valuation. Maybe SOFI doesn't become profitable by 2027. Maybe the net income margin is only 4%. But maybe the PE ratio is actually only 30%, because maybe SOFI is not going to keep growing forever around 20%. So if you use a 30 PE ratio, in this case, the upside is only 35%, or 6% compounded every single year for the next 5 years. Now, in this case, using a 30 PE ratio, I believe we're taking the most type of pretty close to the conservative estimate with a growth company like SOFI, which only yields 35% on the upside. Now, if you want to double your money over the next 5 years and you want to use a 30 PE ratio, which is on the lower end of the range, you have to buy SOFI around $3.71 per share. Now, you might be laughing on this video saying this will never happen, this and that. No one predicted, I think, SOFI to go as low as $4 per share, from $24 per share to $4 per share. So if SOFI went to $4, in my opinion, it could easily go to $3.71. But what if this doesn't happen? What if you want to bet on the best case scenario for SOFI? What if you're 20-year type of investor? You don't look over the next 5 years, you look over the next 20 years. I would not be paying more than $4.50 for SOFI. Somewhere around the 52 weeks low, it could also be a pretty good, short-term investment. If you want to bet on the student loans, type of catalyst, maybe getting resumed, this will give SOFI massive upside. But for me personally, I am not a buyer of SOFI at such prices. If it gets too cheap to ignore, I might still not even touch it, because I have so many other options in the market with less competition, with better valuation. So I don't really have to just go and be dying, to buy SOFI. But if you're interested in SOFI, you want to take, the conservative estimate, I would wait for $3.71 per share. But if you're more aggressive, you a 20-year type of investor and all these type of things, then maybe you could buy SOFI somewhere close to the 52-week close. But it's a pretty good company with good management, good execution, and it's really changed, in my opinion, since I was short the company in 2022. So thank you for watching this video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.